Ben here, East West. Today we're going to examine a strategy with a very high win rate, and we're also going to look at potential problems that a trader may have to endure when they're trading strategies with particularly high win rates. So this strategy was recently released by Peak Trading Research, who I'm not affiliated with. It was for the S&P 500 on a daily basis using the RSI and the ADX. So the indicator settings are quite simple. It's a 14-period ADX and a 2-period RSI. Now let's look at the trading rules. For short positions, the RSI must be above 85, the ADX must be more than 20, and price must be below a 300-period simple moving average, which is used as a filter. Here's an example of a short setup where the RSI is moved above 85 and the ADX is above 20. Price is also below the 300-day moving average. That means we take a short position on the open of this bar. To exit a short position, the RSI must fall below 25. Here the RSI fell below the 25 level, which means we can exit on the open of the next bar. And now for the long setup. The RSI has fallen below 20 and the ADX is above 20, therefore we can take a long on the open of this candle. And price is also above the 300-day moving average. To exit along, we just wait for the RSI to rise above 75. So here it's risen above 75 and we would exit the trade on the open of the next candle. In the description you'll find a link to a GitHub page. On the page will be the full Pinescript code. All you have to do is select everything and copy the code. Then all you have to do is open up the Pinescript editor and simply paste in the code, making sure that you have a strategy. After that, all you have to do is add it to the chart. Also, it's very important that you back adjust your chart. For the purpose of this test, I'm going to be using the deep back testing function. I'm going to use this to generate a custom range to test. Now, some people argue that data going back too far will become unreliable, but for the purposes of what we're doing today, I'm going to be using the 1st of January 2004 all the way through to today's date. For the sake of getting more reliable data, you may want to shorten your start date to something a bit more current. Once you have the range that you want, all you need to do is hit Generate Report. Now, once you've added it to the chart, your page should look like this. You should have the strategy plotted on the chart, and you should also have this overview window open, which shows us some very basic information about how the strategy performed over that time period that we have selected. So for me, for this date range, we've got a very impressive win rate here of 80.56%. Now, I'm not refuting that. I think that's probably not too far off the truth. Now, as with all strategies that have been back tested, it's unrealistic to expect that a future performance will reflect exactly or accurately the back testing results. However, that's not a bad indicative yardstick for what we can expect moving forward. We also have a very good profit factor there of 3.359, which means effectively for every dollar we lose, we made $3.359 back. We've got a max drawdown there of only 2.15%, which is also quite good, and the average trade is healthy at just under $1,000 US. And then of course we've got that net profit of $174,000 US we would have made trading this strategy if we had traded it from the start date all the way through to today. So at this point you may be thinking, okay, well, why would I not just trade this strategy? It looks fantastic. Well, there's a couple of things you've got to think about before you jump headlong into something like this. First and foremost, and this is most important with all strategies that are mechanical in nature, as this one is, that win rate could only have been achieved if you take every single trade. That means there is zero discretion about when you get into the market and get out. When the signal comes, you must take every trade. Now, these are futures contracts and they are expensive to trade. The current margin for a mini S&P futures contract is set by the CME is $13,100 US. Now, whilst the margin would have always been that high, and it is subject to change at any time, I think this is a decent yardstick to use for our testing. With such a high margin requirement, I would suggest that you need a large account balance in order to trade this strategy effectively. For me, I'd be looking at something in the realms of $100,000, though you may get away with something as small as $50,000. The problem here is that if you get caught offside in a market that's moving quickly, you may get margin called, and that is something that you'll have to consider with the strategy. If those sort of numbers sound too rich, perhaps consider the micro contracts. They are a tenth of the size in terms of point value, but they also are a tenth of the size in terms of margin. But of course also they are a tenth of the P&L. Strategies without stops means that you have to consider something called the adverse excursion. Put quite simply, an adverse excursion is how far offside you have to wear a trade until you can exit. Here the adverse excursion was about 85 points, or the market rallied about 2% from where we got into the market. Now we had to wear this for 5 trading days or 7 calendar days, but that's quite a fair distance to be offside. And the problem here is there's no knowing if the market will keep going. Fortunately here, the market did turn around and fell back to give us an exit at a nice profit there of 75 3/4 of a point. But as you can see, we wore way more risk than we got in reward. Risk-reward ratios of less than 1 are generally not advised, as they go against the well-held principles of money management. However, without a stop, this trade survived, and that is what helps give this strategy such a good win rate. That's not necessarily a good thing or a bad thing, but it is just something that you need to consider, because this is a scenario you will be faced with. And I wouldn't have said that's an extreme example. Here is the COVID sell-off. Here's the same system applied to the mini Nasdaq. Here we were given a signal to go long the market, and it is a legitimate signal. Remember, this is a mechanical system, and in order to achieve that fantastic win rate, you must take every trade. And you must not get out of that trade until the system tells you. That means that all through this COVID sell-off, even though the world was falling apart, there was no exit given on this strategy. And that means that if you're going to trade this strategy true, you have to be prepared to wear that sort of movement. And that's why you need a large account balance, because if your account balance was small, you certainly would have been margin called through this period down, and placing money into a trading account, watching a position getting smashed every day, may not be something that you're prepared to do. Now the adverse excursion on this trade was down 25%, or 2,709 points. That's a huge loss. Eventually we were given an exit signal, but we did lose 1,790 points here in the mini Nasdaq on this system. And this is the demonstration of the trade-off for strategies with high win rates that use no stops. This sort of thing can happen, so be aware. Again, I'm not saying that the system is bad, I'm not saying don't use it. All I'm saying is be aware that that is a scenario you may have to deal with. Even now, currently on the hard right edge of the market, there is a long position established by this strategy in the S&P. Through this recent market turndown, we have had to have worn at least a 3% drop, and we do not have an exit signal as yet. Here's the one scenario that really must be considered. The market hasn't lost 50% of its value in quite some time, but it has happened, and it could possibly happen again. Basis today's close, if we fell 50% from this point and we were trapped in that long position, we would lose $137,500. And remember, that may just represent an excursion. However, that might be enough to take your entire account out on one trade. And that is the weakness of the system. That is the trade-off you need to make when trading systems with no stop loss. I think it's only fair also to point out that the system was running through the GFC, and it did manage to avoid losing a lot of money through that period. So whilst that scenario I've painted is probably unlikely with this system, it is certainly not impossible. It needs to be considered. Finally, this strategy tester gives us the ability to download data into a CSV file, which means we can drop it into Python for further examination. So let's go ahead and do that. Here we've taken the data provided to us by the Tradingview backtest, put it into Python to run our eye over it and see if we can extract some different metrics. Now this is definitely only a very small sample of what we could do, but the first thing I see here is that the compound average growth rate of this strategy only sits at 5.6%, so it's not huge. And also the frequency is only 0.8 trades per month. In the chart we've got a breakdown of the P&L returns for each year. Even though this strategy has a win rate of 80%, we can see that in 2018, the strategy actually lost money. So as you can see, just because you've got a high win rate doesn't necessarily mean that you won't have down years. So in conclusion, whilst this strategy does have a high win rate, there are some pitfalls and drawbacks that you would need to be aware of before you began to trade it. I think it's quite a good strategy, But for me personally, I would not employ it without a stop loss. You could go ahead and start to change the strategy, but be aware as soon as you start changing things, you are then flirting with curve fitting, and that is a big no-no. Thanks for watching.